Okay, so let's start the session with Caio Pereira from University of Kansas, right?
Yeah, right.
Yeah, and he's going to present a machine learning factor-based interpretation for the bond risk premia in US. Yeah. So thank you, Caio.
Perfect. Thank you, Professor Bruno, for presenting. Okay, so we'll try to spend a little bit more time here in the motivation and also to give an overview of the paper. And please feel free to interrupt me at any time if you have any questions here. My goal here is not to go too much deep. It's people a little bit technical in some parts, but please just interrupt me at any time. So first I will start with the motivation. So what I do here in one sentence, I study the time risk variation of the risk premium for the US Treasury bonds. This is the goal here. To put this in perspective here, clearly Treasury bonds, why it's important is, right? Treasury bonds is really important for financial markets. It's returning, risk and return dynamics is essential economic importance. So it's major importance for monetary policy, be it strategic for investors' portfolios, be it an institution or not. And it's also really important for us to understand financial events like zero rate that we are currently experiencing right now, and also like in 2008 what we had. So it's important, and to put this now in a better perspective here, the U.S. Treasury bonds. So it's clearly the U.S. Treasury market is the largest government debt in the world. It has an estimated value of outstanding value as of last year of $14 trillion. It's a huge market. And now if you compare this with the whole bond market, so the US Treasury bond represents around 30%. So of course, the other part of the markets would be corporate debt, mortgage municipal bonds, what we have for US. We have money market instruments and also asset-backed securities as well. Okay, so let me, I will speak a little bit more about this because it's a big question and why I'm trying to dive this, try to answer this, or not try to answer, try to provide a new or interpretation for that. But let's just understand what is this risk premium here. So first, I'm trying just to show here the term structure for the US Treasury bonds, right? So here I have this axis here I have from 1990 on, right? So here I have years from 1990s until 2018 or 2019-ish. Here I have the maturities of the bonds that goes from 1 month to 30-year bond. And here I have the yields, right? And so this is what is called the term structure the yields that you have for the US Treasury bonds. Economists, especially macroeconomists, like to say that this, if you look at this picture here, you should be able to see the whole economic history for US, at least for 1990. So this picture here should be able to condense a lot of information for US economy. So the risk premium, it's just what it calls the difference between the long rate. So you pick a longer maturity bond, one of the longer maturity bonds here, and it's the difference between this long maturity bond and the expected average of short maturity bonds, right? So let's say if you buy a bond that is, I don't know, 10-year bond, and you hold this for 1 year, and you compare this if you have bought just a 1-year bond, maturity bond. So there will be a fluctuation price. There is a risk there. This is pretty much what you can understand as the risk premium for bonds. Okay, so so here, just to have an idea, that will be important. I'm showing this right now because this will be pretty much what I'm trying to understand, which is the excess returns, which is the bond risk premium. And here I'm just depicting for you here the lower maturity. So for the first part of this term structure, I'm just taking care of the 2 to 5 year maturities. And here I'm just showing the excess returns. And this from 1962 to 2017, this will be the whole data that we, 17. The whole data that I have in my sample. Okay, so let's talk about the contribution here for this paper here. The contribution, there are quite a few contribution in the methodological part, and I will show this also in the empirical findings, what I show with this new approach that I'm proposing in this paper. So let me just take a step back here and discuss why the question of bond premium, why I'm trying to answer this question here or provide an interpretation, a new interpretation for that. Well, this is a big question, as everyone can imagine. And the problem is this question has not been fully answered. And on top of that, new evidence has been gathering, and this new, I would say, there's specifically a paper that I have in mind here, and this is a paper from Bauer and Hamilton from 2018. And they pretty much discuss about some of these new factors that were proposed lately in the literature for the bond premium, and they showed that there were some flaws, specifically econometric flaws, especially when you're using for longer holding periods. And they show that, well, not necessarily everything that was proposed or have been proposed, it's a good factors to explain the bond premium. So this is still a question that it's still hanging there. And in the next slide, I will specifically show what is the research question. But anyway, what I'm doing here, I'm proposing an overall approach. This is what contribution, okay? And I will try to use a parsimonious number. I will derive a parsimonious number. In this case, it will be up to 2 of state factors. And this will be consistent with theory, okay? This is going to fit naturally in this dynamic term structure with unspent risk. So what I will do specifically, I will use one of the most powerful tools that we have in machine learning as of today, which is a deeper neural network, to uncover relationship in the full set of information from the yield curve. So that's why I'm saying here that I'm being consistent with theory. As of today, we have the big data, and pretty much I could use thousands of sources of information or variables to try to find a linear combination and to try to answer this question. But that's not the goal. Everything that will be done here will be consistent with theory, right? So I will start with theory. Everything that I will begin with theory to do what to use the machine learning. So I will avoid some sort of data mining and specification search that has been done quite often. So I use deeper network. I derive a single state factor that will provide a better approximation to the span factor, to the span space, I mean, of the yield curve. And then the second step is also I introduce a way to obtain the unspent risk. So I have the unspent factor, and this will fit naturally here in this dynamic term structure with unspent risk, which is a model proposed 2013 by Joslin, Singleton, and Purvish. The empirical findings show that this parsimonious number of state variables have predictive power for excess returns for 1 month holding period, which is a much more robust finding if you compare with 12 months or longer, what has been done when they show evidence for other factors. And I provide also intuitive interpretation of the derived factors to show how this is linked with the macroeconomic variables. It's also how it's linked with sentiment-based measures variables as well. There are other findings. I'm just gonna stress these 2 here. Okay, so the research question, and I will just mention here, I use Cochrane. Cochrane and Piazzesi, they provide a factor in 2005, and later he returned on this in a comment for a paper in 2015. And he argued it's possible that there is a dominant single factor structure for bond, such a way that the premiums rise together. So there is a dominant, or as he says, it should be a parsimonious number, it should be 1 or 2 at most. And the research question that I'm trying to answer, which is for the bond premium here, I'm trying to capture, to see what is the linear combination of forecasting variables that capture common movement in expected returns across, in this case, bonds returns. I do a different route, right? So it's possible, what I argue, this is my main argument here. It's possible that the search of deriving, build, and many factors that represent variables in macrofinance may be limited, especially because it has been manually discovered, right? Handpicking. They've been searching. I will just give an example, which is one of the factors that I will compare with, which is Ludvinus and Ling. They pretty much handpick, and they do a specification search to say, oh, which one should I put here and do the linear combination. Since we're doing that, we can use a much more powerful approach and in such a way that you avoid doing this in the, let's say, in the out of sample part. And as I mentioned, I will use one of the most powerful approach, machine learning, specifically a deeper neural network. If I have any questions, if there is no question, I will dive into the hypothesis that's important, and then I will go to the deeper network. If I'm good, I think hopefully everyone is following so far. Okay, so what I have here, I need to just to mention about this hypothesis, which is really important because I start with this hypothesis to do derivation, right? It's a central hypothesis in macrofinance, which is the spanning hypothesis. It just says that all relevant information to forecast yields and excess returns should be and can be found in the term structure. That's all. That's what it's saying. The yields curve fully explain all necessary information. There's no other variable present already in the term structure should be necessary. It's not saying that I don't need any other variable, like let's say macro variable, and as of today, as we have many sentiment-based variable that it could potentially use. It's just not saying that this is not important. It's just saying that the yield curve completely reflects and it spans, that's why he had the name, this information. So all the information that you need to forecast yields and excess returns, you just look to that 3D plot, let's say, and you should be able to get it there. So like I will compare here with three main factors that have been proposed in the literature, which is, we have from Bliss in 87, which is consistent with spanning hypothesis because how they use forward spreads. It's consistent spanning hypothesis, have Croquet and Piazzez, which is also, it's just use a linear combination of forward rates. It's also consistent, and you have also Ludvigsen here, which is not consistent. And just to give an example, I will just show here what Ludvigsen did in 2009. And then they just use a large panel of macro variables, and they find the principal components of this large macro variable panel of macro variables, and they do pretty much a specification search because they use the first loading, principal component loading, the first to the power 3, the third one, the fourth one, and the eighth one. Why? Well, they just pretty much they do this linear combination, and they do this to use as the linear combination of them to explain the excess return of the short matured bonds from 2 to 5. Okay, so with that, I will go straight to the deep learning structure for bond premium that I have here. Well, a prime, okay, it's a primer here. I can't explain much about the deep neural network, how it works. What the deep neural network try to do is it's attempt to replicate the brain structure, right? So it's in such a way that the main idea is I want to add many levels of processing information. Neural network has been around since 1980s-ish. What is new is the deep neural part of that, right? Specifically because we have much more computing power, and thus you can go much deeper. You can add many more levels of processing information, okay? We call deep network in computer science, we call this a supervised learning in the sense that you should have a label, right? So you should have a target and you should have what it's your information that you're trying to feed there, which is pretty much supervised learning. The idea is that you're going to have the target. It's pretty much what we call econometrics, let's say, is the dependent variable. Simple as that, but it's not unsupervised in the sense that you just try to use just the independent variables to try to explain itself. We call it a supervised learning. General structure, I will show the next image here, next slide will be more clear and specific to my structure, but you're gonna have an input layer, and then you're gonna have several hidden layers of nodes, and then you're gonna have several things that you need to predetermine, like for instance, a nonlinear function phi that you're gonna add in each node, and then you're gonna have an output layer. The idea is that it's a learning algorithm, right? So you're gonna feed that, and you're gonna try to find the best data here, which is pretty much the weights that you're going to determine. And you try to learn what is the best data that are going to approximate that function G here, that are going to give a better approximation to your label, to your target, which in my case is the excess return. So let's see in the next image here. Oops, it's going too fast. There you go. So here I can show just a sketch of the idea here, how I propose here to do this here. So I create 4 different groups, one for each maturity. And as I mentioned, I'm just concerned with the short part of the term structure. So I'm concerned from maturity range from 2 to 5 years. Okay. So here I'm going to have the group for 2 years, here for maturity equal to 2, here for maturity equal to 3, here for maturity equal to 4, and here for maturity equal to 5 years. Okay. So I'm concerned only with the short part. So doing this way, I can compare with other factors that did for similar part of the term structure. So you're gonna have your input layer here, right? So you're gonna add the information, this little z here. You're gonna feed your information. This you're gonna be high dimension in the sense that I will feed with the whole information that I have in the term structure. Okay, so I will feed with all the yields, and since I'm doing 1 month holding period, and I can compute monthly yields for each month, I mean, so I can feed with a large, let's say, 60 months or 60 points of data for each T or each month. Okay, so I will feed all this, I will start the process here feeding in the input layer for all groups with the same sort of set of information, which is the information from the yield curve. I tried this also with the forward rates, which is also consistent with the Hispanic hypothesis. But what I'm going to show here, the results is for the yield, feeding only with the yield, only with yields, only yields. So here at the point, it's important I'm being consistent with the Hispanic hypothesis because I'm using just a term structure. I'm not inputting here any sort of macro information, sentiment-based variable, nothing. I'm just starting with yields. And then you're going to have several hidden layers here, and then you're going to have nodes, right? And these nodes going to have, each node is going to have a function of feed, right? And this function here, it's specifically the one that I use. It's a standard one for a feed forward process like this of deeper network. And this here is called verified linear activation function here, which is a max function. I'm not sure if I will have time to mention more about that, but there will be a function that will be activated, that will be in each node. So there will be several hidden layers here. I did several architectures, so I create different designs for being deeper or not. So I created several being even more deep. So you start with 32, 16, 4, and even more, and then you can start with 64 layers and going down until you reach the final, the output layer here. And then you're going to have what's going to call a latent factor here, right? Pretty much is I can just call a latent factor, which will be a latent factor for maturity equal to 2, a latent factor for maturity equal to 3, and latent factor for maturity equal to 4 and to 5 here. So this is the F for DNN for each one of these groups here. And with that, so this is a process, so just finalize here. It's a process doing recursive. So for my period, you're going to feed the information. It's a time series. You cannot break the time structure of that, right? There's clearly, this is obvious. So it's a process that you start to increase, and you're going to do this finding for month and month, this set of Fs here, which is the, let's call latent DNN factors. And with that, I can, actually I will skip this here. I'm just going to show here. I will find this linear combination of my Fs that comes from the deeper network to try to explain the short part of the term structure here, the excess return of the short part. So as similar as was done with Ludwigson or Croquet, I'm trying to explain the average of the excess returns of bonds ranging from 2 to 5 years. This linear combination, tau transpose F here, it's my spanning factor, in the sense that I'm spanning all the information. I'm using, there are many arguments that I use in the paper saying that why this is important. There is a universal approximation theorem that comes from computer science saying why this approach is so powerful. You can approximate, you can learn the theta pretty well, as long as you have a good design for your deeper network. There's a lot theoretical argument. And with that, I will find this spanning factor here, okay? So let me return for this image here and just showing what I fed the deeper network. It was the yield, right? So here I'm just providing to you the yields, and at each T here, you can see the yield ranging from 1 to 60 months. So at each vertical line here, you can have 60 points here. Okay, so with that, and then after, I will not mention much, but I can find at each F, I can find the orthogonal, I can find what is XC or find the residual, which is lying the orthogonal part, orthogonal vector from your F. And this here will be something that's unspanned. So it's any other information that it's not being captured for the deeper network process. And then I will create a function of that. So I will pretty much finalize here the deep learning structure. But I'm just going to mention, and this fits in the model from Jocelyn, and I do a quick, a small adjustment. But anyway, my goal here is to say is this first factor here, which is the spanning factor, and the second one is a function of the x's that lies in the orthogonal vector from your f. They represent, and z, which is all the possible information, all the state variables. They represent linear rotation from the same full list of factors. So my point will be that this and these two here, the spanning and unspanning, will be the two state variables that I need to explain the bond premium here. So this, as I mentioned, this fits in this in the model proposed from by Jocelyn in 2014. And my argument here is that C, or a function of C, could be capturing macroeconomic information, sentiment-based variables, which is not in the term structure. So that's why I need the unspanned part as well. Okay, so here how it looked like, the results. I think I have like 9 minutes or so. I think it's enough. So first, I'm trying to show the Fs that I find in my deep neural network process of finding this F, estimating this F, not estimating or finding this Fs. So here I have years in this axis, here I have years. Here I have the maturity, so remember that I'm just concerned from 2 to 5. I'm not going longer maturities. And here I have the DNN factors values here. So first, as you can see, it's as the process starts, this is clearly a computational cost, takes days for you to do that. But this, as it starts, you can see a little bit radically the process, but as it goes, it stabilizes. And you can see a similar pattern as you see for yields. You can see that it flips. Standardly, it's lower maturities, you're going to have a lower F or DNN latent factor, and then longer mature, you're going to have a higher one, and it flips during recessions. And this, you see this here in 2001-ish, here when it flips. This is a 3D plot that in my website I put this, you can play and see the DNN factors. And here, 2008, it also flips. So here I want to compare in this image here. Finally, I have the DNN factors, and then I do linear combination and find my spanning factor. So here I have my spanning factor in black. Here in red, I have the Krokanian PSS factor for the same period using 1 month holding period. And here in blue, I have Ludvigsen-Ing factor as well. So as you can see, they are completely different. They are not alike. I show in my paper that do correlations and so on. There is a little bit more. The correlation between my factor and the Ludvigsen one, which use principal components of a macro variable, macro data set, it's pretty much zero. They're almost pretty much orthogonal. It's like the correlation is -0.3, -0.03. And then with Krokanian PSS, which use a linear combination of forward rates, there is a little bit of correlation, but it's really low. There is a little bit of correlation in the beginning here between 1993 and 2001, but then the correlation pretty much disappears. And here I'm comparing now the unspanning factor here. This is my unspanning factor is in green, and also compared Krokanian PSS factor and Ludvigsen-Ing as well. Now you can see that there is a little bit more correlation. You would be able to see, and the paper showed the values clearly, a little bit more correlation between my factor and Ludvigsen one. And this perhaps there is as it should be perhaps because Ludvigsen and Ing factor, it's completely not using spanning factor, so it's using macro information only. Okay, so I show in the paper, I do the forecasting experiments for all 2, 3, 4, and 5 years. I do an auto sample. I will not have time to mention that, but here just for 2 years, I'm trying to show here this is my spanning factor. This is my unspanning factor. So as I mentioned, there is a little bit of econometrics here that I use orthogonalization, but this is the unspanning factor. This is Ludvigsen factor. This is Fama-Bliss factor, and this is Krokanian PSS factor. Okay, and here I'm trying. The goal of this table here is to show that my factor, the power of my factor, does not disappear, even if I add any other possible factor or main factors that I have in literature. So here you can see that it keeps being statistically significant. It does not matter if I compare it to the Ludvigsen, Fama-Bliss, or Krokanian PSS. And you can see that Fama-Bliss disappears. pretty much for lower maturities, at least it appears that it's not statistically significant. Clear I'm using robust standard errors here. And also the second point that I address here is the adjusted R-squares are pretty high. Here I'm comparing, I'm adding in this regression here, let's say just spanning factor and Bingson, the R-square here is 18. But when I did in another, I have more results. The R-square, when you use just my factor or my factor and my spanning factor and then spanning factor, the adjusted R-squares are really considerable as well. The second part here, just the correlation, just to show there's the spanning factor here, unspanning factors, and possible alternatives for that. But as I mentioned, the correlation between my factor and the Bingson factor here, it's pretty much negative. It's I think it's 0.05, not 0.02, which is pretty much orthogonal. There is a little bit of correlation, especially in the first part of the experiment with Croquet and Piazzez. This is the main takeaway. And clearly here, they are all orthogonal. This is the spanning factor. These are the unspanning factor. They are orthogonal. By construction, they should be orthogonal to fit in the model that I'm using. Now, the final part here, and I will be finalizing here. Do I have a question? I don't know.
No.
No?
I wrote in the chat 3 minutes. That's what I wrote in the chat.
Okay. Yeah, good. Yeah. I thought something was blinking here. All right. Okay, so just to answer the question, there are many other results that I show, but this part here, I just want to answer this part. Okay, I have a factor, a spanning factor, I have an unspanning factor. Okay, they provide good approximation forecasting. They have good forecasting power, even when compared with the main factors in the literature. And then you're going to ask yourself, well, okay, well, how can I understand that? Is this linked with how this is linked with the economy, right? So this is what I'm trying to answer here. So I do a marginal R-square experiment. So I use the Fred data set here with 128 macro variables, and they are grouped in 8 groups, like output and income, labor, and so on. And I'm just regressing one and just projecting my factor on them, and then trying to see where can I see more correlations here. The higher correlations you're going to see specifically would be for money and credit, so M1, M2, and so on, and some important variables here in the group of interest and exchange rates. Now, the much more interesting here is the unspanning factor captures some variables that are left out in the group of interest and exchange rates, specifically some treasury bonds that are not captured intriguingly in the first in the spanning factor. Sorry, here with the spanning factor. I have many more results. I did an out of sample experiment and I compare with the others, and I'm not showing here. I did a bunch of robustness. I did using because there are 2 steps estimation. I did one single step using GMM, generalized empirical likelihood. I compared this also with the principal components. I did a bunch of other. But here I try just to show an overview. The main idea is my contribution is there's some methodological contribution and propose a new way, and I show that this works quite well, and possibly there's a route to be followed here to try to answer this question of bond premium here for U.S. Treasury bonds. So what I did, I proposed a novel approach for derive a single state factor, a single spanning factor. I use a deeper network to do that. There is a bunch of theoretical arguments for that. With that in my approach, I'm able to derive a single state spanning factor, and then I have a second factor which is the unspan. In this way, fits in a new model for the term structure. And I show that this parsimonious number of state variables have predictive power for 1 Bolton holding period, not 12. I can't do. I did that for 12 too, but I'm probably going to put this in the appendix. Which is 1 month is much more robust. And finally here, I provide intuitive interpretation for the derived factors. So I show how it's linked with the macroeconomic variables and sentiment-based variables, which also I did not have time to show today. Well, that's what I have prepared for today.
Thank you so much, Caio. Like if you have one question, we have time for that. Okay.
Quite technical.
What?
maybe, I don't know, it's a little bit technical some parts, but I hope.
Yeah. That's probably, yeah. Gustavo, are you there?
Yes. Hi, Bruno.
Okay. Hi.
I will stop my share.
Yeah. So, Gustavo, if you can share your screen with us.
Sure. Let me do that. Can you see it?
Yes.
Okay, let me.
So you have 30 minutes.
Okay.
Yeah. So it's a pleasure to have Gustavo here. He's going to present tail risk and investors' concerns. So thank you, Gustavo.
Thank you, Bruno. Thank you all for being here. I'm Gustavo Freire, and the paper I'm going to present here today is called Tail Risk and Investors' Concerns. So let me start with some motivation here. So there are several papers that incorporate time-varying disaster risk to solve a number of asset pricing puzzles. For instance, the well-known equity premium puzzle. And closely related, there is a literature proposing several different methods to estimate time-varying tail risk. So for instance, we have Boleslav and Todorov, who use large amounts of option data. Kelly and Young explore the cross-section of individual stock returns under a parallel argument aggregation to estimate tail risk. And Almeida and co-authors estimate the tail risk as the excess expected shortfall under a risk-neutral measure of a set of portfolio returns. So the evidence from these papers is mainly from the US, and after estimating tail risk measured and relating to market returns and real outcomes, it indicates that tail risk strongly affects the stock market and the real economy. So essentially what this literature has in common is that tail risk can be estimated from asset prices because they reflect investors' concerns about future states of the economy. However, what I ask here is what types of concerns drive tail risk fluctuations? Are concerns about the economy or the government, or about disasters such as the coronavirus pandemic or the 9/11? So in other words, what are the origins of tail risk variation? And I think this is important to first map how the effects of tail risk in the stock market and the real economy relate to the different investor concerns that tail risk identifies. And second, to learn about the economic agents' perception of tail risk. Third, to provide insights for modeling disaster risk. For instance, what types of events should we consider to calibrate these models? And fourth, to help guide economic policy towards minimizing tail risk. So in this paper, I'm going to estimate tail risk for Brazil using the methodology in Almeida and co-authors. So this method is particularly useful here because it requires only a set of portfolio returns that we have easily available. So it doesn't require like large amounts of option data or to use the whole cross-section of individual stocks. So it is a useful method here. And I provide new evidence on the effects of tail risk on the stock market and the real economy outside the US for important emerging markets that it is Brazil. And this is interesting because the whole evidence that we have is for developed countries. So, and arguably emerging markets are more subject to uncertain shocks and tail risks. So I think this is interesting to document. And I also extract information about investors' concerns from news coverage following this paper by Manella and Moreira. So basically, I'm considering that the time variation of the words chosen by the business press proxy for the evolution of the average investor concerns over the time. And using the co-movement between tail risk and the news coverage, I'm going to identify the investor's concerns driving tail risk fluctuations and investigate its implications. So what are the key findings of this paper? So tail risk is counter-cyclical. So when the market's high, tail risk is low, and when tail risk is high, the market's low. And tail risk positively predicts future market returns. So this indicates that investors are tail risk averse, so that they require higher returns on the market when tail risk increases. And I also find that tail risk negatively predicts employment and industrial production. And we can think in the sense of tail risk being representing an uncertainty shock that influences the investment and hiring decisions of firms. They postpone employment and their production, and this represents a decrease in these real outcomes after a tail risk shock. And I find that tail risk is mainly associated with concerns about disasters, the economy, and the government. And I find that disaster concerns explain most of the variation in tail risk, followed by economic concerns, and then less variation explained by government concerns. And in one hand, the economic concerns that tail risk identifies explains the countercyclical property of tail risk. And on the other hand, the disaster concerns explain both the predictive power for market returns and the negative impacts on real outcomes. So these findings support the recent models using time-varying disaster risk to explain asset pricing behavior. So I'm going to go into more detail in all these points briefly. So let me start here presenting briefly the methodology used to estimate tail risk. So I follow the paper by Almeida and co-authors here to estimate tail risk at month T as the average of the tail risk of K assets. So these will be portfolios, which for each asset, the tail risk is calculated from the daily returns in this month as the excess expected shortfall under a non-parametric risk neutral measure. So here in the equation, you can see that the aggregate tail risk is given by the average of the individual tail risk of each asset, and the tail risk of each asset is given by this excess expected shortfall under this risk neutral measure. And here, this value at risk is a quantile in the left tail of the risk neutral distribution. And we can interpret this expression here as the payoff of a synthetic out-of-the-money put option, where with the risk neutral measure here, this whole expression is like the price of this synthetic out-of-the-money put option. So we are extracting information about the left tail of the risk neutral distribution with this risk neutralization here. And we identify this risk neutral measure using a non-parametric method to identify the risk neutral measure that is closest to the physical distribution while correctly pricing these daily returns in the month. So this is the tail risk measure that I'll use for each month to calculate tail risk. So the data that I used, I estimate tail risk from daily returns on 9 portfolios sorted by size, book to market, and momentum. They are available at Nefin. And using these portfolios is advantageous because they summarize priced information in the cross-section, and they allow us to not use individual stock returns, which can be noisy and introduce noise in the estimation of the tail risk measure. And also get data on excess market returns and risk factors. And I'll use the risk factors as controls in regressions. I also obtain data on the economic policy uncertainty index for Brazil. And there are some papers showing for the US that the EPU is a relevant risk factor. So I consider here also as a control, as a different uncertainty measure. And I also get data on employment and industrial production from IBGE. So this is the estimated tail risk measure for Brazil from 2001 to 2020. And you can see here the tail risk measure is in blue, the trend is in red, and I also provide some annotations for the most relevant episodes here. And as we can see, the tail risk peaks at the coronavirus pandemic is the highest peak in the whole sample. And it's followed by the peaks in the financial crisis, the subprime crisis, and the European debt crisis. Also in this stock market crash here due to regulations in China's stock market. And the tail risk measure also peaks to political shocks. For instance, the impeachment of Dilma, the JBS deletion, the diesel crisis, also some concerns about Lula's policies. and in disaster events, such as the coronavirus pandemic and the 9/11 in the beginning of the sample. So in sum, we can see that the tail risk measure provides a comprehensive depiction of the occurrence of extreme events in Brazilian markets over time. So what I'm going to do next is to investigate the relation between market returns and tail risk with contemporaneous and predictive regressions. So these are the contemporaneous regressions, the excess market returns on tail risk and the controls, and the predictive regressions for different horizons on the tail risk and controls at time t. So the controls I include the EPU index and the risk factors for size, value, momentum, and liquidity. So here I report the results. In the columns, we have the regressors, and focusing here first on the panel A, the contemporaneous regression, we can see that the coefficients for tail risk is statistically significant and strongly negative. So this indicates the counter-cyclical property of tail risk. And on the other hand, EPU is not significant to explain current market returns. And the risk factors also display an important effect on current market returns. In panel B, I show the results for the predictive regressions for several horizons here. And focusing first on tail risk, we can see that there's a positive coefficient for all horizons. So it indicates that tail risk positively forecasts market returns. And again, this indicates that when tail risk is higher, investors require higher returns on the market to hold it. And this indicates that tail risk is a relevant risk factor in this economy and it carries risk premium. And you can see that this relation is significant for most of the horizons, even after controlling for all the risk factors. EPU doesn't show much predictive power for short term, only for long term. And the size factor is also important, and the other factors are less important here. So I also, yes.
Just a quick question. The variation of tail risk here is in standard deviations.
Yes, exactly. Yeah, I report all the results here for standardized variables in order to make interpretation easier. Otherwise, because the magnitude of these different regressors is different, and this would impose like very different coefficients here. So all variables here are standardized.
Okay, thank you.
And I also provide an additional analysis of out-of-sample market return predictability. So to do that, I first use data only through month T. I start with a window with a significant size, like 120 months, in order to have an initial sample size to estimate it. And using data only through month T, I estimate the coefficient of tail risk on market returns in a predictive regression. And then I use this coefficient to forecast the T+1 return out of sample. And then the estimation window is extended by 1 month in order to construct an out of sample forecast in the following month. And I proceed with this, I repeat this procedure until the whole sample is exhausted. And then I have a series of forecast errors that I use to calculate out of sample R-square, given by this expression here, where the benchmark is the historical average market return through T. And basically what we need to understand from that is that a negative out of sample R-square indicates that the predictor performs worse than forecast given by the historical mean, while a positive one indicates that it performs better. So I'm going to investigate the out of sample R-square for tail risk and for the other predictors that I consider. So these are the results where I report the out of sample R-square in % for each predictor and for each horizon here. And what is interesting to note is that tail risk is the only predictor with positive out of sample R-square for all horizons. So tail risk always performs better than the historical average. And for 3 months and higher horizons, this performance is statistically significant at the 5% level. EPU doesn't show much predictive power out of sample, more for long term. And the size factor performs a little better, but also performs worse than the historical average for 3 months. And the other factors also doesn't display much predictive power out of sample. So this again confirms both these results and the results from the previous regressions confirm that the tail risk has a strong effect on the stock market in Brazil and carries risk premium. So after documenting that, what I'm going to do next is investigate the relation between tail risk and economic activity. So to do that, I'll estimate a monthly vector autoregression where the variables in the estimation order are the log of Bovespa stock market index, the stock market volatility, this is the standard deviation of the market returns in month T, tail risk, log employment, and log industrial production. So basically my goal here is to analyze the response of employment and industrial production to a 1 standard deviation shock to tail risk, controlling for a shock in volatility that is shown to be important in the literature. So here I report the imposed-response functions. So here is the response of employment to a volatility shock, and this comes from the estimation. So we can see that here are the months after the shock. So you can see that about 7 months after a volatility shock, employment decreases by minus 0.4%. And then there's a rebound recovering after 2 years. And here we get the response to a tail risk shock. We see that tail risk provides an incremental impact on employment, so that after 4 months, employment decreases by minus 0.2%. And then again, there's a rebound 2 years later. And the impacts on the industrial production are more pronounced. So after a shock in volatility, industrial production falls by minus 1% after 4 months. And then there's a rebound about 8 months later. And as for the tail risk shock, you can see that it generates like an immediate decline in industrial production of about minus 0.8%. And then there's a rebound 5 or 6 months later. So this shows that a tail risk shock precedes large contractions in real outcomes in the Brazilian economy. So far I documented the effects of tail risk on the stock market and the real economic activity in Brazil. So what I'm going to do next, now I'm going to follow Manella and Moreira in considering the time variation, the choice of words by the business press as a proxy for the evolution of the concerns of the average Brazilian investor. So in order to do that, I'm going to extract daily news from the front page articles of the online version of Valor Econômico from 2011 to 2020. And I'll need to treat this text, so I'll eliminate punctuation, digits, and stop words. And in the end, I have to use a part of speech tagger for the Portuguese language, where I leave only nouns in the sample, totaling about 22,000 words that can represent the concerns of the Brazilian investor. And from these words, I'm going to generate a high dimensional vector of word frequencies. So for each month, the frequency of word J is given by the number of appearances of word J in month T, divided by the total words in month T. So we get a vector of word frequencies that I'll be using to explain tail risk with a linear regression. So here is the vector of word frequencies explaining tail risk over time. And these coefficients here will give us direct information of how given words representing given concerns of the investor affect the tail risk measure. And what is important here is that this is a high dimensional regression where the number of predictors is much higher than the sample size. So we have to use some machine learning techniques, some regularization method to estimate this regression. And I'm going to use ElasticNet. I find that it works really well for this situation that we are facing here. And so here I report some results of this estimation. These are the most important words for tail risk, where the blue coefficients here indicate words that when they appear in the news, they lead to higher tail risk. And these in red are words that when they appear, they lead to smaller tail risk. So the first thing to note here is that the word crisis is the most important word for tail risk. And this is followed by words mainly related here to economic concerns, such as the economy, companies, credit, firms, bonds. And we can also see words related to the government, such as minister, governors, ministry, government. And we can also see words related to the coronavirus pandemic, such as epidemic, virus, quarantine, and of course, I forgot to tell you that the words in the news are in Portuguese, but here I'm reporting their translation to make it easier to see. But in the paper, I provide all the translations there, but you can also see here the words that lead to smaller tail risk. So such words are revenues, construction, productivity, inflation, consumption, performance, project. So this gives a clear view of the types of concerns that tail risk identifies. And basically you can see that it identifies heterogeneous concerns, that tail risk identifies heterogeneous concerns. So in order to further analyze in more detail the relation between investors' concerns and tail risk, I also follow a procedure in Manella and Moreira that is to group words in different categories representing different investors' concerns. So the way I do that is I look at the words explaining 99% of the tail risk variation, so basically almost all tail risk variation, and these are about 200 words from the high dimensional vector. So you can see that the model selects a small set of words that explain tail risk. And among those words, I'm going to select the words that I think are related to these different categories here. So the first category is a disaster category, where the top words are the word crisis and words pandemic, epidemic, quarantine, and shock and other words. And this category explains 61% of the variation of tail risk. Here I show how to calculate this variation, but mainly shows that disaster concerns explain most of the variation in tail risk. And this is followed by this economic category, which is composed of about 43 words. And here I put words that are here: the economy, the companies, credit, firms, bonds, and all those words related to the economy or the stock market. And I also create here a government category that explains 66% of the variation. And these are words related to the government or economic policy, such as minister, government, pension, ministry. And then the remaining words compose an unclassified category, which explains about 15% of the variation. So I'll use these categories of words to investigate what types of concerns explain the effects of tail risk on the stock market and the real economy. So just to show you here, once I categorize these different concerns, I can calculate the tail risk that is implied by each category. So we have the tail risk here implied by the disaster category, the economic category, the government category, and the unclassified category. And you can see some interesting insights here. For instance, disaster category usually implies smaller tail risk than the economic category, but in the coronavirus pandemic, it peaks higher than all the other categories. You can also see that the government category, coronavirus pandemic, is not as important as other episodes here, and here in the political crisis of Brazil. And so I'm going basically to use this time series of tail risk implied by these different categories to investigate the implications of tail risk on the stock market and the real economy. So first here, I run the same regressions that I ran before, but using only the categories implied tail risk. So here you can see in panel A the contemporaneous regression, where you have here the disaster, economic, government, and unclassified categories. And as we can see here, the counter-cyclical property of tail risk with respect to market returns is mainly explained by the economic concerns that it identifies. You can see here a negative and strongly significant coefficient for the economic concerns. The government category doesn't explain nothing about current market returns. The unclassified category also explains some of the contemporaneous relation with market returns, while the disaster category is a positive relation here that doesn't explain the countercyclical property. And in panel B, we can see the predictive regressions, and the result is very clear here that for almost all horizons, the disaster category explains the predictive power of tail risk for market returns. And we can see again, these are strongly significant positive coefficients, while here for the economic concerns, these coefficients are not statistically significant. The government concerns only have predictive power for long term, similar to the EPU, which I show in the paper that is related mainly to government concerns. So you can see here that in Brazil, it seems that the variables accounting for government concerns only explain future market returns, only risk premium for long term. The unclassified category also explains some future market returns for these horizons, but the main takeaway here is that disaster concerns explain the predictive power for market returns, and this indicates that tail risk, that the investors only require compensation for tail risk coming from the disaster concerns that it identifies. And I also investigate here the impulse response functions for each category implied tail risk. So what I do here is to estimate the same VAR as before, but for each for each category implied tail risk separately. So we can see here analyzing the response of employment and industrial production to a disaster implied tail risk shock, that the figures are very similar to the ones for tail risk. Here we have about 6 months later a minus 0.5% shock decrease in employment after a tail risk shock implied by disasters. And similar here, an immediate drop of industrial production of minus 0.8% and then a rebound. And all these effects here are statistically significant at the 5% level, given by the one standard error bands. So you can see that while for the disaster implied tail risk, the patterns, the effects on the real outcomes are very similar to tail risk, for the other categories is much less pronounced. Like the economic category here still has a negative effect on employment, but the effect here on industrial production is not statistically significant. The same here for government concerns. So we can conclude that the effects of tail risk on the real economy can be explained again by the disaster concerns that tail risk identifies. So to conclude, that was what I had to show here. Tail risk has strong predictive power for market returns and negatively predicts real economic activity in Brazil. And using news from Valor Econômico as a proxy for investor concerns, I investigate the origins of tail risk variation. And tail risk is mainly associated with concerns about disasters, the economy and government uncertainty. And I show that the strong effects of tail risk on the stock market and economic activity can be explained by the disaster concerns that it identifies. So taken as a whole, these findings support recent models explaining asset pricing behavior with time-varying disaster risk. So that's it. Thank you.
Thank you, Gustavo. Thank you so much. We have time for one more question, maybe.
Quick question here, so it's more technical. Really quick. So when you did your AlaskaNet, how did you do your tuning parameter there? Did you use the cross validation, or did you
Yes.
take the time structure and do the spending cross validation? So did you just do this just a standard cross validation or no?
Yeah, just a standard cross validation, a 5-fold in the sample to choose the hyperparameters. So the simple procedure, the usual procedure.
You think that would change your results if you, because it's a time series, you cannot just randomly pick, right? Could you like do expanding one? Do you think would change the results of your cross validation, right?
Yeah, so I think the results are pretty robust to different specifications of the cross validation. And I also used a different method called support vector regression that also regularizes in a different manner. And the results are very similar to using AlaskaNet. So I think that the words that are more related to tail risk are pretty robust across different specifications of the AlaskaNet and across different methods in the machine learning literature.
Perfect.
But Gustavo, one quick question, like follow up on Caio's question, which is,
sure.
Maybe he's asking about like if you randomly like selected the elements from the cross validation, or if you really considered like the time series for each fold, which I think you did. You didn't like do traditional cross validation like what is described in like machine learning books, where you randomly select, like without considering structure. So is it what you were asking, Caio?
Yes, exactly that. Yeah, I think you're more
so
precise. Yeah.
He considered the time series nature,
great,
because he didn't like randomly pick. Great. He considered blocks.
Great.
Yeah, that's a good point. I think I didn't consider the time series blocks. I think it was randomly selected. I don't know. I have to look into that, but that's a good point. I think it would be reasonable to maintain the time series structure here. Yeah.
Thank you.
Thank you.
Okay. Thank you, guys. So now it's my turn. Let me share.
Let me stop sharing here.
Yeah.
Sorry.
Okay. So I'm going to present this paper, Price Transparency in Over-the-Counter Equity Lending Markets, Evidence from a Loan Fee Benchmark. It's co-authored with 4 colleagues. Sereda was an MA student at USP, and we were his advisors, and this was his thesis. And yeah, that's it. It's a basketball team, 5 guys. And okay, so the equity lending market is over the counter, and so it's opaque for its participants. And this consequence of that is that short sellers, they are poorly informed about current loan fees by the time they want to borrow a stock. They can't see other deals that are happening at that time, at the same time. And this is all over the world and also in Brazil. The fact that the equity lending market is over the counter. But here in Brazil, there is a small difference, which is that all loan contracts must be registered by the brokers at the end of the day with the exchange, B3, B3. And so the exchange, by the end of the day, it has all the data, which doesn't occur in the US, for instance. So here in Brazil, the equity lending market is opaque for participants, as in the rest of the world. But here, at the end of the day, the exchange has the data. And then researchers may also have the data, which is good. And then we can study this market. Okay, but this paper is about a policy by the exchange using its data, and which reduced the price opacity in the equity lending market. The exchange reduced market opacity in 2 occasions. One was on March 1st, 2004, when the exchange began to make public a stock level loan fee benchmark on a daily basis, which was the average loan fee for each stock over the past 15 days. This was on March 1st, 2004. So before that, nobody knew anything. Like you would like to sell short a stock, you would have to borrow it. You have no clue about what would be a fair loan fee, because like you were in the dark. So with this benchmark, short sellers were at least informed about the average, the 15-day average loan fee for that stock, which was a good information. On March 1st, 2011, this information got even better. The average interval was reduced from 15 to 3 days. So now short sellers knew what was the last 3 days average for that loan fee. And we have the data to study this change here. Okay, so this is the communication of the exchange by the time, just before the benchmark change. And it said, like, we hereby inform that as of March 1st, 2011, the average fees will be computed on a 3 business day period. And as present, its published period is, the average period is 15 business days. So that was the change. And then they said that we highlighted the purpose of this change is to make securities lending market service ever more transparent. So that was their goal, which is important, as we will see, for the equity lending market and for the stock lending market in general. So let me show you that reducing the moving average window from 15 to 3 days did increase the benchmark precision. So, like, imagine this is a stock, a specific stock, JBS, JBS. So the black line is the daily loan fee, the daily average loan fee. The red line is the 3-day benchmark, the average loan fee computed using the 3 previous days. And the blue line is the 15-day benchmark. And when loan fees are stable over time, when volatility is low, they are close to each other, the 3-day and the 15-day, obviously. But in more volatile periods, the red line, of course, gets closer to the current loan fee. So this is the prediction error when you use the 3-day and the 15-day benchmark, and they are pretty close to each other in calm periods. But when you have volatility in loan fees, the 3-day benchmark is much better than the 15-day benchmark if you want to nowcast loan fees. Our question is, what were the effects of this positive shock in price transparency? This is our question. And we test 5 hypotheses. They are inspired by the theoretical predictions of this paper, Duffy, Dvorak, and Zhu. And hypothesis 1 is loan fees fell with the new benchmark, because now we have better informed short sellers, and their bargaining power increases because they are better informed. And since loan fees fell, if loan fees fall, the lending volume may increase. And this is the second hypothesis. The lending volume increased with the new benchmark. And if short sellers are now better informed, high-cost lenders, the ones who charged higher loan fees, they may lose market share with the new benchmark. And this is the third hypothesis. Here we have loan fees falling, and maybe as I will show to you, loan fees did fall, and as I will show to you, the lending volume did increase. So what was the net effect on lenders' aggregate revenue? Because fees are falling by one hand, on the other hand, volume is increasing. So for lenders, what was the net effect? And then we have this hypothesis here that we're going to test. The lenders' aggregate revenue was not reduced. So like high-cost lenders may have lost market share, but aggregate revenue of all lenders may have not reduced with the new benchmark. And hypothesis 5 is that, okay, so loan fees, high loan fees, they are not good to the stock market because they restrict short sellers. So when loan fees fall, the stock price efficiency may increase. And this is what we test in the last hypothesis. The stock price efficiency increased with the new benchmark. So that's it, the 5 hypotheses we test. Data, we observed the complete activity in the equity lending market from 2008 to 2011. This is a data set that came from the exchange directly. Gennaro Allen was the responsible for getting this data set. He used to work there. And it's the same data set used in this paper also here. Okay, so in our baseline analysis, we focus on the 2-month period around the benchmark change. So we have 1 month before the change, 1 month after the change, because ideally we want to have constant conditions to analyze the effect of the change. So we have to work with a small window around the effect. Then in our robustness section, we'll make the window wider, but this is our baseline analysis here. Okay, so let me show you a picture about the loan fee level. So this is the average loan fee across stocks for each day within the window around the event here. So this is the day of the benchmark change. And the figure suggests that, well, maybe the change had some effect, at least like we see loan fees going up here, and then loan fees go down here. Average loan fees after the change are clearly lower than average loan fees before the change. And we want to run some regressions about that. So we run in our baseline analysis stock day panel regressions. So this is the average loan fee for stock S on day T. And in our first specification, we run it on a dummy, which is one after, for the days after the change, that is for the days in March. And here we have some controls to try to control for market conditions, past returns, past volatility. I will show them to you. Here we have stock fixed effects, and that's it. So this first regression, beta 1 tells us whether average loan fees within a given stock are lower after the change compared to before the change. But then maybe there was a decreasing trend since the beginning of February. And if there were, like, the picture shows that this is not the case, but maybe there is a trend when you control for these variables here. And so we want to control for a possible negative trend since the beginning of February, because if there was a negative trend, so the effect may not be due to the benchmark change per se, right? So in our second specification, we have a time trend since the first day of the month before the change, February. Okay, so here beta 1 captures average loan, compares average loan fees after the change with average loan fees before the change, controlled for a trend. And here we also, in the third specification, we interact the trend with the after dummy, because maybe the effect of the benchmark change was not on the level, but was on the trend. And this third specification allows us to look at that. So this is the regression. We may focus on this column here, which is the most complete specification. And what we find here is that beta 1 is negative and significant. So average loan fees before the change were Q86 bips per year, and then after the change they are 35 bips lower. Okay, and here we run the same column for all other pair of subsequent months during the whole sample period, and as we can see here, the true pair of months, February, March 2011, delivers the larger and most significant, the larger and most negative T statistic for beta 1 or beta 1. So in perspective, something atypical did occur here. Okay, so we run the same regression for the median loan fee for stock S on day T. We have the same result. We run also deal level regressions instead of stock day regressions. And this is good, this is interesting, because it allows us to control for investor stock, the intersection of investor and stock. So it allows us to control for investor stock fixed effects. So this effect here is not due to a possible change in the composition of investors, of short sellers. So within investor stock, for a given pair investor stock, we observe a decrease in loan fees after the benchmark change. Okay, and this is also interesting, like as we see here, the effect of the change is stronger when loan fees are more volatile. So if we split stocks in two groups based on their loan fee volatility 10 days before the change, so this here we have 15 stocks that we call that we say they are in the low volatility group. Here we have 15 stocks that we say they are in the high volatility group. We expect a stronger effect of the benchmark change for this group here, right? And this is the plot, like the high volatility group, maybe mechanically here, it had a higher loan fee before the change, and the loan fee was going up. This is the low volatility group with a lower loan fee, possibly mechanically, and the loan fee was kind of stable, of course, mechanically, because that's the way we split the stocks. But then when the change comes, loan fees in the high volatility group begins to fall. We see a stronger effect here, possibly than here. And to test this, we run the regression with the interactions, with the a dummy for identifying the high group. And we find that although after is significant for both groups, it's stronger for the high volatility group. Here. Okay, so let me go quickly in the other four hypotheses. We run the same regressions. This is our baseline specification throughout the whole paper. Here we use lending volume on the left-hand side, total lending volume for stock S on the AT. And here, controlling for the trend is important. If we look at specifications 1 and 2, lending volume, average lending volume is not different after and before the change. But when we include the trend here, we can see that there was a negative trend on average lending volume throughout the whole period. And once we control for that, we see that the average lending volume after the trend is 35% higher than before the trend. This is log total volume, so this is in percentage terms. So here it's kind of dubious because it's important to control for the trend. Market share of high-cost lenders. So we use the whole previous sample from 2008 to the end of 2010 to split lenders, to classify lenders as high cost. They are the ones who charge the highest loan fees on each day. And we see that after the change, they lose market share as expected, because now we have better informed short sellers, and this guy who are expensive lenders, they naturally will lose market shares. When we look at total lending revenue, what is the lending revenue? Is the loan fee times the loan volume. Okay, so by one hand, when we look at these specifications here, let me go back. The lending volume here does not increase at this specification here. Since loan fees decrease, so here we find that lending revenue after the change becomes lower, 17% lower or 22% lower than the lending revenue, the total lending revenue before the change. But again, once we control for a possible trend during the whole period, then we have volume going up, loan fees going down, and it seems that in our most complete specifications, when we control for the lagged returns and volatility, we see no change in the total lending revenue. But again, we have to control for a possible negative trend during the whole period that we have no explanation for that. So it's a little bit ambiguous here as well, the result. And in terms of price efficiency, in general, what we mean by price efficiency here, or price inefficiency, is how important lagged market returns are in this regression. When we regress the stock return on a given week, on the market return on the same week, and we include lagged market returns, how important those lags are. The more efficient the market, the less important those lags here, right? And we look at this at a 6-month window, because to estimate these regressions here, since people usually use weekly returns, we need a larger window here. And we look at a 6-month window and at a 12-month window, and we find that these lags here, they are always more important. And these are different measures in terms, we use R squares or T statistics. These are different measures. And independent of the measure, we find that these lagged returns are more important before the change than after the change. So it may be that the lower loan fees may have increased price efficiency. Okay, concluding. So we find that loan fees fall with the new benchmark. We find that the lending volume increases with the new benchmark once we control for a negative trend during the whole period. We find that high-cost lenders lose market share with the new benchmark. We find that lenders' aggregate revenue is not reduced with the new benchmark. Again, once we control for this possible negative trend in the whole period. And we find that the stock price efficiency may have increased with the new benchmark. And that's it. Thank you so much. And so if you have questions, we have time for them. Let me see the chat here if you have any question on the chat. No, it doesn't seem to have. Okay, guys.
So can we ask questions freely?
Sure.
Okay. So I see that you're using a method that's not like diff and diff because you don't really have a control group, right? So, yeah. But you sort of split the sample in between high and low variance, right? So sort of and to sort of try to overcome this. Mm-hmm. So it seems to me like there's a difference between firms that are firms that are informationally sensitive would be a lot more affected than firms that are less informationally sensitive. And there's a bunch of measures in the literature of information sensitivity. So maybe you could split the sample between firms that are informationally sensitive and those who are not, So to sort of get a better sort of control group for that. I mean, there are a bunch of measures that you can use. One of in the literature, one of it is firm's age, time since IPO. There is one that's by Agarwal and Housewell that is distance to the stock market, physical distance. So, you know, if a firm is located in, for example, JBS is located in Goiás, which is far away from São Paulo, which would be make it more information sensitive than a firm that had its headquarters in São Paulo. So
That's a nice suggestion. Thank you. So, and this information sensitivity, like this information is about information about news about the stock, right?
Yes, I mean
news about the stock, yeah, and yeah. I'm not sure to what extent the new benchmark, because the new benchmark increases the information of short sellers about current loan fees. And what you're saying here are measures that capture the sensitivity of the stock through information about like news. I have to think a little bit more about that, but it sounds like a clever idea indeed.
Yeah, I'm assuming that there is some sort of correlation between the prices of the stock rental and the stock price itself. I mean that these things are somewhat related. If they are, then you know if there is stock sensitivity to information, then there is the same kind of sensitivity in the rental contracts.
Got it. Yeah. Thank you so much. Thank you, Rogério. Okay, guys. So I think if you don't have any further question, we are done here in our session. So
Thank you, Bruno.
Thank you so much, guys. Thank you.
Thank you.
Thank you. Bye-bye. It was a really nice session. Thank you.
Thank you. Bye.
Thank you, Bruno.
Oi, Bruno, aqui é o Diogo. Fiquei como seu host aqui. Eu vou estar parando a gravação, tudo bem? E finalizando.
Tudo bem.
Tá bom?
Maravilha. Então vou fechar aqui já também, né?
Parabéns aí, eu vou fechar aqui.
Tá bom. Obrigado, Diogo. Um abraço. Tchau.